Hello, and welcome to MRA's 5-Minute HR Feed, the podcast where we share quick and practical information. In the time it takes you to go grab a cup of coffee, you'll gain insights into hot topics and pressing HR issues. I'm your host, Nicole Morehouse, and we're glad you're listening. Before we start, here's our usual disclaimer that the information being shared is not and should not be considered legal advice. Now let's dive into our topic.
Alrighty, welcome everyone. Thanks for joining us today. I have 5 minutes. That's not nearly enough time for this topic, but hopefully you're happy to hear that I'm going to touch on some key provisions of the One Big Beautiful Bill Act. The One Big Beautiful Bill Act, and its final version was, I think, 870 pages long. So wrapping this up in 5 minutes would be quite a feat. So I will share with you that there will be an article that accompanies this podcast that has some higher level of information to provide to you. But this podcast is to create some awareness about some of the things that are tucked into this budget reconciliation bill that is going to be highly impactful to employers and organizations alike. So let's get started. I am going to primarily focus on the ones that caught our attention in the news. And that's no federal tax on overtime and no federal tax on tips. Very, very catchy headlines. While it's an eye-catching headline, there are a lot of specifics when it comes to quote unquote no tax on overtime and tips here. So one of the key things to think about is looking for the definition of qualified overtime compensation and qualified tips. That's very important. For qualified overtime, that means compensation paid as required under Section 7 of the Federal Fair Labor Standards Act. So commonly, we know that is 1.5 times the employee's regular rate of pay for any hours worked over 40 in a week. So real quick example with that, if an employee is regularly paid $30 an hour and their overtime rate is 1.5 times that, that's $45 an hour. And if they work 45 hours in a work week, right, the qualified overtime compensation when it comes to the provision in this bill is the half time. So that's 45 minus 30, so that's $15. Is the halftime, and then that's used to calculate what is deductible. So in a 45-hour work week, that'd be $15 times 5 hours, which would be $75. So some math there. Sorry about that if that's hard to follow with in a podcast, but I wanted to give you a quick example. So there are a lot of other things to consider when it comes to the no tax, quote unquote, no tax on overtime, other than whether or not the overtime is qualified or not. There are, of course, limits and caps to how much can be claimed, how much the employee can earn, and whether they're filing as a single taxpayer or married and filing jointly. But it is important to know that this will be allowed for non-itemizers. So that was one of the questions I very early on got asked. And does this mean that someone would have to be somebody that itemizes their deductions? And so this is allowed for non-itemizers. So I want to tell you, when it comes to the no tax on overtime, some things to prepare for now. Start reviewing how you calculate hours and earnings. So think about hours and earnings codes that are used in payroll, and how everything is compiled and that sort of thing, because you're going to have to make sure that the qualified overtime can be reported on. So start reviewing your policies and procedures as well, related to when you pay overtime, how you pay overtime, and those sorts of things also to make sure, because this is for tax years 2025 to 2028. And guess what? It's 2025. It's right in the middle of the year in 2025. So, going retroactive to figure out qualified overtime earnings might be on a list to do for some of you that are listening. So get ready for that. So also start by contacting your payroll, your HRIS vendors, to make sure that you understand how they're going to update everything from a system perspective and how Form W-2 is going to be configured to allow for accurate reporting of qualified overtime. Similarly, with no federal tax on tips, Qualified tips does mean something specifically. So that's cash tips received by any individual in an occupation which customarily and regularly receives tips on or before December 31st, 2024. So that definition has to be already in play. And so the term cash tips includes tips received from customers that are paid in cash or charged. And in the case of the employee, the tips are received under any tip sharing arrangements. So it's important to note that the tips must be paid voluntarily without any consequence in the event of non-payment and is not subject to negotiation and is determined by the payer. So that's an important fact that sticks out specific to that. Same thing with the tips. There are, maximum amounts that can be deducted, and there's like earning caps and those sorts of things as well. So some additional details there. Like I said at the beginning of the podcast, we are going to have a robust summary of all of this for you that will itemize or by line detail tell you some of the more specific items that might be important to you. Same thing with the tips is the overtime. It can be deducted by non-itemizers. With the no tax on tips, you do want to also review if you have employees that receive tips, how are your employees receiving tips as compensation? And think of any potential considerations given that they are going to want to claim a deduction and not pay federal tax on those tips. So also review your tip reporting procedures. And again, ensure your payroll and HRS systems are going to be set up accurately and all ready to go in order to accurately report tipped income. So those are the big headlines. And I know that those are probably some of the big questions. But as people start to read this 870 pages of this budget reconciliation bill, like I have, and I've read some of the provisions multiple times to really try and thoroughly understand exactly what the provision is telling us. Here are the other major areas of that I think employers need to really kind of be in tune to right now. And I would look for our article and anything else that we're putting out in the coming days to make sure that you look for those in the places that you normally receive information from us, right? Like that's your inbox, emails, social media, our website, the hotline. Call the hotline for this information as well. The other areas that you're going to want to look for and become familiar with are impacts to high deductible health plans. So something that is being extended is a safe harbor for high deductible health plans to offer telehealth without a deductible. So that safe harbor is continuing for plan years after December 31st, 2024. So there's some actionable steps that we'll share with you in the article for that as well. Health savings accounts for months beginning after December 31st, 2025. And of course, with some exception and limitations, which are described in detail in the bill. A direct primary care service arrangement, if you're familiar with those, a DPC, those aren't going to be treated as a health plan. So long story short, participants in HSAs, if they enter into a DPC arrangement that meets the definition of a DPC arrangement as defined under the bill, that could happen without jeopardizing their ability to be enrolled in an HSA. Flexible spending accounts. This is some great news for parents out there with one temporary change to it. I think this is the only time that they've changed the maximum pre-tax maximum contribution limit for dependent care FSA. So hooray for parents out there that have children in care where they're paying for that. So the current limit is $5,000. 2,500 if you're married and you file separately, but it will go up to 7,500. So that's a significant bump, or 3,750 if you're married and filing separately. So that's some big news, but employers will have to get ready for that, obviously. So we'll have some actionable steps for you on that as well. Trump accounts, and they're actually called Trump accounts in the bill. So this one is a lot of the provisions in the One Big Beautiful Bill Act are fairly complex. This is one that is definitely complex. So in essence, in general, with some exception, a Trump account, it'll be kind of the same as an individual retirement account, but obviously it's focused on contributing to a child that's under 18 so that then when they turn 18, they can get their disbursements and those sorts of things. So that we're going to advise that you talk to a tax professional. There's a little bit more to the Trump accounts than typically you would see would be like in kind of like the HR wheelhouse. So that's something that a tax professional, should be consulted with, because I think there's some questions of some of the language in the bill around contribution limits. The bill does define a contribution limit of initially at $5,000 per year. So, but there are some questions around where those contributions can come from. There will be an extension in the bill that allows for, there is an extension in the bill that allows for a continuation of employers to be able to use Internal Revenue Code Section 127 plans to reimburse qualified student loans. So that's just an extension of something that is currently happening. Also, with paid family and medical leave, if that's something that you offer, the bill does make an extension for tax years after December 31st, 2025. And then the last item that I am going to highlight for you today, and I'm sure I'm going over the 5 minutes by a couple of minutes here, but changes to Medicaid, but there's going to be some changes to Medicaid eligibility, and those begin in 2027. And I'm messaging this to you because one of the eligibility options is to work at least 8 hours per month. And if that's the case, and that's an option for someone to maintain their Medicaid eligibility, does the W-2 then have to have hours worked on it? Which that would be my assumption. So that could be the impact to employers. So with that, I know that was a lot. Again, we're going to have an article for you on this that goes into greater detail, but we did want to deliver you some, all right, start thinking about these things now in this particular podcast, and to encourage you to watch for that article, watch for other things that MRA will be putting out for you to help you really start on a path to compliance with the provisions of the One Big Beautiful Bill Act. With that, thank you for listening. Have a great day.
Thank you for listening to MRA's 5-Minute HR Feed. Be sure to follow and connect with us for more podcasts and updates. If you're a member and have questions, you can always connect with MRA's 24/7 HR hotline by emailing infonow@mranet.org or by calling 866-474-6854.